Yeah. So today we will introduce an agency relationship in the portfolio management problem, and we'll see what the consequences are. Okay, so to do this, I'm going to rely on this paper by Doe and Gorton that introduces noise trading and delegated portfolio management. And so the idea is that now the economic agent who is managing the funds, and we're going to call that a fund manager or a manager for short, is not the owner of the funds. Okay, he is mandated to do that. So there's delegation happening. And so a principal, to think about a pension fund, for example, is hiring a fund manager to manage the fund and to make decisions. Okay, so what's going to happen? So to understand the implication of this agency problem for portfolio management, for trading, and for pricing in financial markets, we're going to study a very simple model. Okay, so in this model, there's a security which pays off either H or L. So this is the fundamental value of the security. Often we're going to set H equal 1 and L equal to 0. Each with probability 1/2, and the payoff is at time 1, whereas the security is traded at time 0. So it's a model with 2 dates. As in the CAL model, we have a market maker who sets the security price in such a way as to break even, to make 0 expected profits, because the market maker is competitive. And why is the market maker considering expected profits? Simply because it is risk neutral. Okay. So now let's get to the agency relationship. So as I mentioned before, this is going to be a principal, someone who has funds to manage, with hiring a fund manager. And there's 2 types of fund managers. And fund manager can be either talented or untalented. Untalented fund managers never receive any information about security value. They are unqualified, they don't know how to interpret any information they might receive. And so we view them as always uninformed. Okay. Whereas talented fund managers, so these are people who are qualified and we can make sense of the information. And these fund managers are going to be informed with probability alpha. So if they receive some valuable information, and also if they do not shirk. So if they work hard and they get lucky, so with probability alpha, talented fund managers are going to be informed. Informed means that they are going to learn the fundamental value of the security, so whether the payoff is equal to H or to L. And untalented fund managers have no idea. Okay, moreover, to make things simple, we're going to assume that the population consists almost entirely of untalented fund managers, meaning that if you do not screen out, if you do not reject untalented managers, you're going to for sure hire an untalented manager. Okay. Because the principal cannot observe the manager's type, and they all look identical to you. It's just that some are talented, some are untalented. Okay, so regardless of their type, fund managers are risk neutral and protected by limited liability. So this is important. It means that they cannot be punished because transfers to them must be positive. Moreover, any fund manager can earn K in another occupation. So if they take another job, if they reject the contract offer by the principal, they can earn K. They can also earn K if they accept the contract offer from the principal, but they do not trade. So let's say they do something else on the side. They don't really work for the principal. So they are shirking, they do not trade, in which case they will also earn K. Okay. So already we can see that the contract is going to have 2 purposes. The first one would be to screen out untalented fund managers. And the second purpose of the contract would be to make sure that talented fund managers are going to work hard, to not shirk. Okay, So these are the first three economic agents in the model. So the market maker, the principal, a fund manager. With some probability, delta, there's also going to be a hedger who's going to trade in financial markets. And this hedger is risk averse. And that's going to give him a motive for trading. He's simply going to want to hedge his wealth because of his risk aversion. And someone with risk neutral would not care about that. So this hedger has pre-existing wealth W and utility function U, who is concave because he is risk averse, and is exposed to a shock that follows a Bernoulli distribution. So Bernoulli distribution means that the random variable will be either equal to 0 or to 1. So it's a binary outcome. And there's two possibilities. With probability 1/2, this Bernoulli distribution will be perfectly positively correlated with the security payoff, meaning that the shock will be equal to 1 when the payoff is H, and the shock will be equal to 0 when the payoff is L. And with probability 1/2, this distribution would be perfectly negatively correlated with the security payoff, meaning that the shock will be equal to 0 when the payoff is H and to 1 when the payoff is L. Okay, so there's these two types of hedgers, some with positive exposure to the security payoff, some with negative exposure to the security payoff. Okay, so for them, they are going to be involved in financial markets for hedging purposes. Okay, and they are going to trade a quantity of plus or minus X, depending on their exposure to hedge their exposure. Okay, so for now, we just take the quantity X as given. We will determine what X is at the very end. Okay, so there's quite a few things to keep in mind in this model. The first thing we're going to want to ensure is that at the contracting stage, when there's two types of fund managers, untalented and talented, the untalented, so in red, is going to reject the offer, and the talented fund manager will accept the offer. Okay, so what does that imply for the contract? Okay, so first of all, what is a contract? That's a principal will offer to a fund manager. So a contract can specify the payoff or the payment that the manager will receive depending on the outcome. So the first possible outcome is that there's a successful trade. Let's say the manager bought and the payoff was H, or the manager sold the security and the payoff was L. So it's a successful trade. You bought or sold when you should have. So in which case, the payoff to the fund manager will be either MH or ML. The payoff can specify a payment of M0 for no trade. Potentially, you might want to reward the manager for not trading. And why is that? Well, simply because for whenever the manager makes an unsuccessful trade, because of limited liability, you cannot punish him. So you can only receive a payment of 0. Okay. Okay. So now let's take the perspective of an untalented fund manager. And we know that the principal is going to hire an untalented fund manager for sure, if an untalented fund manager is willing to accept the contract. So we must make sure that any untalented fund manager would reject the contract offer from the principal. So when would that be the case? So if the untalented fund manager rejects the offer, he will get K. K is what they can get in another occupation. So this is the K you have here. Now, what happens if the manager accepts the offer? Well, let's get back to this figure. So if the manager accepts the offer, well, he can do two things. Either it will not trade. So if the manager does not trade, remember they earn K if they do not trade. Okay, so that's the K you get here. Plus there's the payment M0 for no trade. Okay, so if the manager does not trade, you get this, which is what you have here. Okay, now what happens if the manager decides to trade? Well, remember, he's untalented, so he is uninformed, for sure. So then there's two possibilities, right? So the payoff can be either H or L. If the payoff is H, well, the fund manager is uninformed, so he will trade randomly. With probability 1/2, he will get lucky with a buy order. So then he gets rewarded. He gets MH, and with probability 1/2, he will sell. He will get unlucky this time, and he gets a payment of 0. Okay. Same thing if the output is L. Again, the fund manager is uninformed, so he's going to trade randomly, trying to get lucky. He's going to get lucky with probability 1/2, and by selling, so he will get a payment of ML, and he will get unlucky with probability 1/2 when he's buying, and in which case he gets a payment of 0. Okay. All right. So we must make sure that what the manager gets when he accepts the contract offer, which is the max between these two things, is less than K. So why is it the max between these two things? Because the manager, after he accepts the offer, will go there with no trade if K plus M0 is greater than the other term, and otherwise he will go there. So he will try to randomly trade. Okay. So what is a necessary condition for this whole term on the left-hand side to be less than K? Well, as you can see here, we have K plus M0. So we need to have M0 equal to 0. It's not a sufficient condition, but it's necessary for an untalented fund manager to reject the offer. If M0 were positive, well, for sure, this will be greater than K. So the max between this and whatever else will also be greater than K. So we need to have M0 equal to 0. And so this allows to solve the adverse selection problem. If M0 were positive, meaning if you were rewarding the manager for not trading, you would for sure hire an untalented fund manager. Okay, so sometimes you need to punish some behavior, not because the behavior is bad, but because it could attract the wrong type of economic agents if you were to reward this behavior. Okay, so setting M0 equal to 0 allows to solve the adverse selection problem. You will hire a talented fund manager. So someone will possibly be informed. But it is creating a moral hazard problem. So we're going to understand why. So now let's take the perspective of a talented fund manager. The contract is still the same, with rewards for successful trade, a payment M0. Now we know that M0 must be equal to 0 for no trade, and also 0 for an unsuccessful trade. Okay, so let's take the perspective of a talented fund manager. And also, as you can see, we can set the rewards for successful trade at the same level, and we're going to call that M. Okay, so a talented fund manager is going to be informed with probability alpha. If he is indeed trading, he is informed with probability alpha. Okay, so his probability alpha is informed. With probability 1/2, the payoff is equal to H, in which case he's going to buy because he is informed, so he makes the right trade. With probability 1/2, the payoff will be L. Then the manager is going to sell, so he makes, again, the right trade. And so in any case, he gets a reward when he's informed, right? So this is the expected payment to the manager when he is informed. Now what happens when he is uninformed? So he's going to be uninformed with probability 1 minus alpha, in which case with probability 1/2, the payoff will be equal to h. Now the manager is uninformed, so he trades randomly, just like an untalented fund manager would. And with probability 1/2, he's going to get lucky, so he's going to get the reward. He's going to buy when the payoff is high, and with probability 1/2, he gets unlucky. He sells when the payoff is high and gets 0. Okay. Now same thing if the payoff is actually L, is low. With probability 1/2 is buying, so he gets unlucky, payoff of 0 for him. And with probability 1/2 is going to sell. This time he gets lucky because the payoff is low. He gets the reward ML, so which is equal to M, like MH. Okay. So now we must make sure that this is greater than K, right? We want the talented fund manager to accept the offer. So when is that the case? So now we're going to use this equality, as you can see. So this is going to simplify a lot. So we're going to get this, and if we rewrite it and we solve for M, we solve for the contract. So here that involves solving for the reward for a successful trade. We find that the talented fund manager would accept the offer if and only if M is greater than this. Okay. And finally, because the principal wants to minimize the cost of the contract, we are simply going to set M at the minimum possible level, such that this condition is satisfied. So M is equal to this. Okay. So now let's get back to this graph. So let's make sure that everything is fine. So we have, again, two types of managers, talented or untalented. We made sure that by setting M0 equal to 0, so the untalented fund manager will reject the offer. We made sure that by setting M sufficiently high, a talented fund manager would accept the offer and would indeed trade. So what happens when the talented fund manager engages in trading? So with probability 1/2, output is H, and with probability 1/2, output is L. Okay. So if output is L, with probability alpha, the fund manager will be informed, and with probability 1 minus alpha, he will be uninformed. So that means that if he sells with probability 1/2 when he is uninformed, he's going to sell with probability alpha plus 1 minus alpha divided by 2, and this is equal to 1 plus alpha over 2. Okay, and he's going to buy with probability 1 minus alpha over 2, right? With probability 1 minus alpha is uninformed, and with probability 1/2, he gets unlucky when he trades randomly. Okay. And then, of course, when he, with a greater probability, he will make the right trade, so he will sell, in which case he will get the reward ML. Okay. Likewise, so in the other case, when the payoff is high, is going to be informed with probability alpha. And when he's not informed with probability 1 minus alpha, is going to make the right trade with probability 1/2. Okay, so overall is going to buy with probability alpha plus 1 minus alpha over 2, which is 1 plus alpha over 2. Okay, so the right trade means buying, and it means getting the reward. With some probability, even though the manager is talented, he is uninformed. And also he gets unlucky. So he's uninformed with probability 1 minus alpha, and also then he's unlucky with probability 1/2. So then he gets a reward of 0 because he makes the wrong trade. He's selling when the payoff is high. Okay. And so why is this happening, right? So this is a bit surprising because we have a talented fund manager, so he is uninformed. And yet, even though he's uninformed, is optimally deciding to trade. rather than not trade. So why is that? Well, this is because we could not reward not trading, because doing so would have attracted untalented fund managers. So we could not reward not trading. But if we do not reward not trading and we reward successful trades, and yet we cannot punish unsuccessful trades because of limited liability, in this case, it means that the fund manager is always better off trading and trying his luck, even when he is uninformed. And so this is referred to as churning. And churning simply means you're going to trade, you're going to engage in transactions, even when it's completely pointless to do so. Okay, even when it's not based on any information, you are just somehow pretending to be informed by engaging in the same actions that an informed economic agent would. Okay, so the uninformed fund manager is going to mimic the behavior of an informed fund manager, but of course, in some cases, is going to get unlucky. Okay, but even then, if you get unlucky, you get a payment of 0, which is the same as the payment you would get for not trading. M0 equals to 0. So by engaging in trading, you can only win. You cannot lose. And so this is why I said here that setting a reward of 0 for no trade, so that may indeed solve the adverse selection problem. You're not hiring an untalented fund manager, but that creates a moral hazard problem that induces the wrong type of behavior in the manager that you are hiring, because it encourages random trading, which is again referred to as churning. Actually, so in the paper, Doe and Gorton refer to this as noise trading, because the manager is actually trading based on noise, based on nothing, essentially, right? And it's also interesting because this is not purely random, right? In the Kyle model, liquidity trades were completely random. Here, noise trading is the outcome of some optimizing behavior. It's simply because there's some distortions when there is an agency relationship in portfolio management that is going to generate this type of a priori surprising outcomes. Okay, so let's summarize what happened here. So the optimal contract must be such that the rewards for not trading are equal to 0. As long as the rewards for trading are greater than the rewards for not trading, so here it should be ML, a fund manager will receive some information, is going to trade. So how do you set the rewards for successful trades? They are set at a level such that a talented fund manager is going to accept the contract and is going to trade, i.e. is not going to shirk. So this is the case with this reward. Now, if you take the perspective of an untalented fund manager, so if he were to engage in trading, so we didn't check, so what is the value of this term here? We must make sure that this is less than K. But this term here is just equal to this. Essentially, an untalented fund manager who trades get lucky with probability 1/2. And then we substitute for the value of M, which is here. And so the expected payoff of an untalented fund manager who trades is then equal to this. And as you can see, this is less than K. Okay, meaning that the condition here will still be satisfied because this is less than K, as we just established. And also with M0 equal to 0, this is less than K in a weak sense. Okay. Now, if we take an uninformed fund manager, so he's going to get an expected payoff of M over 2, and this is actually the same one as payoff of an untalented fund manager who is trading. So he gets this payoff if he trades and a payoff of 0 if he does not. So optimally, he will always be trading. And so this is churning. He's going to trade based on nothing to mimic what an informed fund manager would do and possibly get lucky. With priority 1/2, he's going to get a reward. Okay. So now let's take the perspective of the hedger. And we still want to understand how the financial market is going to work in this context. So we will also want to have some trades which are not based on information or on noise. And here they're going to be based on a hedging motive. So as we already discussed, there's two types of hedgers, right? There's, first of all, the hedger can have a positive exposure to the asset payoff, in which case the wealth of the hedger will be equal to W plus 1 when the payoff is high. Then you can have a hedger with a negative exposure to the asset payoff, in which case his wealth will be equal to W plus 1 when the payoff is low. Okay, so it's a perfect correlation with the asset payoff. And of course, at the very beginning, we don't know. So if we take the perspective of the hedger, we don't know if the payoff will be low or will be high. We just know that if the payoff ends up being low, our wealth will be equal to W plus 1. And if the payoff ends up being high, our wealth will be equal to W. Okay. If we have a negative exposure, right? We know whether our exposure is negative or positive. So we know if we are a hedger, whether we are this type or that type. We just don't know what the payoff will be. Okay. So what will the hedger do? So first of all, we know that with some probability, 1 minus delta, there will not be a hedger. Okay. So there will not be any trade submitted by a hedger. And with probability delta, there will be a hedger. And then with probability 1/2, this hedger will have a positive exposure, in which case he will want to sell the asset for hedging purposes. And with probability 1/2, this hedger will have a negative exposure, in which case he will want to buy the asset for hedging purposes. So that's the market order of the hedger. Okay, so now we know how everyone will trade, the hedger and the fund manager. So now let's take the perspective of the market maker, who is setting market prices so as to make 0 expected profits, so as to break even in expectation. So first of all, so what are the order flows that the market maker will possibly observe? Well, we know that the fund manager will always trade, right? Because in equilibrium, only a talented fund manager will accept the contract. This talented fund manager will always trade. So he will always submit an order. However, the hedger will only trade with probability delta. Okay. Moreover, the fund manager will submit exactly the same market order as a hedger would, meaning plus or minus X. So why is that? Well, it's simply because if an informed fund manager were informed or uninformed, actually, so if a fund manager were to submit a market order different from X, the market maker would instantly know that this is an possibly informed fund manager trading against him. And so the prices, the market prices would move against the fund manager. Okay. So to avoid this, and it's in the same spirit as the Kyle model, the fund manager will submit the same orders as the hedger in order to not reveal his type as a fund manager. Because again, the market maker knows that the fund manager will submit possibly informed trades, whereas the hedger will not. Okay. So the fund manager is going to try to not be identified as a fund manager. Okay, so he's going to submit the same market orders as the hedger, so plus or minus X. So first of all, yeah, so then there's this three, so there's 5 possible outcomes, and depending on whether the fund manager is buying or selling, and whether the hedger is buying or selling, or is simply not there. Okay, so what if the aggregate order flow is equal to 2x? So when can that be the case? That can only be the case if both the hedger and the fund manager are buying. Okay. But now if the fund manager is buying, it could be because he is informed and he made the right trade, or it could be because he is uninformed. So if we go back, there, the informed fund manager will buy in this case when the payoff is equal to H, but the fund manager will also buy with this probability in that case when the payoff is equal to L. Okay, so from the perspective of the fund manager, of the market maker, sorry, when the market maker observes an order of 2x, so it means that the fund manager is buying. So then what's going to be the belief updating? So it's probability alpha, the fund manager is informed, in which case the value of the asset is H. But with probability 1 minus alpha, the fund manager is uninformed, and so is just churning. So the order is completely uninformative, meaning that there is no belief updating, meaning that the expected value of the security is 1 plus H plus L over 2. Now this is just the expected value of the security. Okay. So this is the expected value of the security from the market maker's perspective when the market maker knows that the fund manager is buying. Okay, if we just rewrite this, it's equal to this. Now, what if the order is X? So when can the aggregate order flow be equal to X? Well, the fund manager is always buying or selling. And so when you just observe an order flow of X, it means that simply the hedger was not trading. Okay, so when you observe an order flow of X, belief updating is exactly the same as when you observe an order flow of 2X. Okay, it means that the fund manager was buying. But once again, this trade might have been informed or uninformed. So it was informed with probability alpha and uninformed with probability 1 minus alpha. So it's exactly the same thing as here. Same inferences, same belief updating. Okay. So now what if the fund manager observed an order of minus 2x? So it means that both the hedger and the fund manager were selling. So what really matters is that the fund manager was selling. But again, the selling could have been either because the fund manager was informed, in which case the security value is L, or it was uninformed and it was just churning, in which case the expected security value is just the unconditional value of the security, which is this. And so we get this price. So here PS refers to the price when traders were selling. PB refers to the market price when traders were buying. Okay, and the same thing if the order aggregate order flow is just minus X, it still means that the fund manager was selling. And so PS in this case is the same as PS in that case. Last case is when the aggregate order flow is 0. So then it can mean one of two things. So the fund manager is always trading. So if the aggregate order flow is 0, it's because the orders of the fund manager and the hedger canceled out. So then there's no new information, right? Because it could have been that the fund manager was buying and the hedger was selling, or the other way around. We don't know, right? And everything is symmetrical, it's probability 1/2. So there's no new information. So the price, the market price in this case is P0. 0 refers to the aggregate order flow. And the price of the security is equal to the expected value of the security payoff with unconditional expectations. And so it's equal to this. Okay, so there's 3 possible prices. So PB, PS, and P0, depending on the order flow. And as you can see also, the magnitude of the price change when the order flow is positive or negative is increasing in alpha, which is the probability of informed trading. So the more informed trading there is, the greater the magnitude of the price change, which makes sense. Okay, so we're almost done. The last thing we need to do is that we need to determine what the quantity X, which is bought or sold by the hedger, and as a result also bought or sold by the fund manager. So what X is going to be. And so it's going to be determined by the optimization problem of the hedger. So here note that the amount of X is not going to change belief updating by the market maker. So the hedger does not worry about this. But X is going to change the wealth of the hedger in different states of the world. And because the manager is risk averse, is going to want to equate this wealth as much as possible. Okay, and so X is going to be chosen with this objective in mind. Okay, so what is X going to be equal to? Well, we need to solve the actual optimization problem of the hedger to find out. So we need to do it step by step by considering all the possible states of the world. And here I'm going to consider the problem of a hedger whose shock is positively correlated, and we know that these are perfect correlations, with the security payoff. So I'm considering this type of hedger with positive exposure. And we're going to consider the expected utility of the hedger, and that involves considering all 4 possible states of the world and writing down the utility of wealth based on the hedger's trade in each of these states of the world. And then we want to maximize this expected utility by choosing the value of X. Okay, so let's go slowly. Let's do it step by step. So with probability 1/2, the payoff is going to be equal to L. So now we have a hedger. We have a hedger who is going to have a positive exposure to the asset. So this is a hedger who is going to sell. Then there's 2 possible cases. The payoff is equal to L and the hedger is selling. Either the fund manager is selling as well, in which case the order flow is minus 2X, so both are selling, or the fund manager is buying. Then that cancels out with the order of the hedger, and the order flow is equal to 0. The hedger is selling, the fund manager is buying. Now, with which probability is the fund manager selling as well when the payoff is equal to L? Well, it's going to sell with this probability. and the fund manager is going to buy with that probability. Where do I get this? I get this from here. When the payoff is L, the fund manager is going to sell with this probability and is going to buy with that probability. Okay, so what happens then when the order flow is minus 2x? Well, order flow minus 2x, then the price is PS, and it's equal to this, okay? So that's why we have a price of PS here. The fund manager is selling, so he's taking a short position with an order X. And so with a short position, the payoff is equal to the price minus the actual payoff of the asset. Now what about the other case, right? So the fund manager is still selling, so he's still taking a short position with a payoff equal to the price minus the payoff of the asset, and it's the opposite of a long position. But now, so the difference is that the order flow is 0, right? So when the order flow is 0, what is the price? It's P0. Okay, so that's why we have a price of P0 right here. Okay. Okay, let's do the other case when the payoff of the asset turns out to be equal to H. And of course, when the hedger optimizes and chooses the quantity is going to trade, it doesn't know whether the payoff will be equal to L or to H, so we take expectations. So when the payoff is going to be equal to H, again, there's two possible cases. So the hedger still has a shock which is possibly correlated with the security payoff. So the hedger is still a seller. He's always selling. We know that the fund manager is either going to buy or to sell. So when both end up selling, we still have an order flow of minus 2x. And when the seller, when the hedger is selling and the fund manager is buying, the order flow is equal to 0. But now, of course, what's going to be different is that the payoff is equal to H. So the fund manager is going to buy or sell with different probabilities. And in particular, when the payoff is equal to H, the fund manager was going to buy with this higher probability and is going to sell with this lower probability. So with this lower probability, both the hedger and the fund manager will be selling. So the order flow is negative. And with this higher probability, the hedger will be selling because of his type. But the fund manager will be buying in part because of his information. Okay. And so what is the wealth of the hedger in this case? So remember, this is a hedger whose shock is possibly correlated with the security payoff. So this type. So when the payoff is L, the wealth is W. This is the W we had here and there when the payoff is L. But when the payoff is equal to H, the wealth of the hedger is W plus 1. And so now when the payoff is H, the wealth of the hedger is W plus 1. W plus 1 plus whatever the trade is. So still the hedger is selling. And so the net payoff from the position will be equal to X, the quantity sold, times the price at which the hedger sold minus the price at which the asset was bought back. And so now, of course, the payoff is H. And so you must buy back the asset at this price, not at this price. Okay. Otherwise, it's still the same, right? When the order flow is 0, the price is P0, just like it was up here. And when the order flow is negative, the price is PS, just like it was up there. Okay. So we went very slowly. And here we got it right. Actually, if you look at the article, the original article by Doe and Gorton, they take the perspective of a hedger whose shock is negatively correlated with a security payoff. So you can try to do that as a homework, try to see if you get it right, and compare with what they get. So if the shock is negatively correlated with the security payoff, this other hedger would actually buy a quantity X, and also his wealth would be W plus 1 when the payoff is L, not when the payoff is H. So that would be the differences. Okay, so now it's actually quite easy, the next step. So this is the expected utility. And to find the optimal value of X, we differentiate with respect to X. And the first order condition is such that this derivative is equal to 0 because the second order condition holds. Okay, so you differentiate with respect to X, you use the chain rule. So that's why you're going to get some U prime here. This is just some basic mathematics, even though this is a pretty big expression. So you're going to get this equal to 0 at the optimal X. One thing we must still verify is that the hedger is still better off trading. So here the idea is that even if the objective function of the hedger is concave in X, if the derivative is negative at 0, the optimum would be given by X equal to 0, meaning that the hedger would not trade. You would have a function which is just decreasing and concave, and so the optimum would be at 0. So we don't want that, right? We want the derivative to be positive at X equal to 0, so that the optimum is indeed given by the first order condition, where the slope of the function is equal to 0. Okay, so when is that the case? So now we evaluate this derivative at X equal to 0. Again, it's pretty simple. It's just a big expression, right? So we find that it's equal to this. And if we rewrite a bit, we find that it's equal to that. And is this the case? Is this expression positive? And the answer will be yes. Why is that? Because here we use the fact that U prime of W is greater than U prime of W plus 1 because the agent is risk averse. And again, it makes sense, right? It's because the agent is risk averse that he is going to get a hedging motive. If he were not risk averse, by trading, he would just move prices against him. And so he would be better off not trading. So we still want to make sure that this condition is satisfied, which it can be if the agent is risk averse. Okay, well, that's it for the model of Doe and Gorton. So I encourage you to read the introduction of the paper. It's quite insightful, as well as you can look at the problem of the hedger that they solve as well in the paper. That's some good homework as well. Okay, thank you.